There's the closing bell on Wall Street, and now it's market domination overtime. Jared Blicker going to be along in a moment to get us up to speed on the action from today's session. I'm going to start with the numbers here for the major averages, and we are seeing some late day buying into the weekend. This is a welcome development for the bulls who've been watching all of the selling that's been going on. We've got the Dow up 222 points right now, and really the change today was when we heard Fed Chair Jay Powell speaking midday, and as one of our guests said, not sounding panicked about the state of the economy, despite a lot of forecasts for GDP, particularly in the first quarter, being cut, not being cut to contraction, but still being cut to more slowing growth and well below 2% growth in many cases. All of that said, did see a gain today on the Dow. The S&P 500 finishing higher about 0.5% as well. And the NASDAQ also finishing near the highs of the day, up 0.7%. Jared, we have seen enormous swings, however, on a daily basis, not just today in the markets.
Yes, we have. 7 days in a row, the S&P 500 has moved, not necessarily up or down, but has moved 2%. And let me show you the 5-day total for the NASDAQ composite, down about 3.5%. For the S&P 500, down 3.1%. Various times today, it has been the worst week for both of those, the NASDAQ and the S&P, since September. And we'll have to see how that shakes out in the final tally, but that's what we are looking at. And let's take a look at the bond market. The 10-year T-note yield up about 3 basis points today to 4.32%. And I've been tracking volatility, talking about those swings today. We are still holding above 20. This VIX has been persistently higher over this week and also starting last week as well. So that's kind of a different character for the VIX than we've seen recently. The dollar, on the other hand, opposite rates, it has been going down. I believe this is the 5th or 6th day in a row for the Dixie, the U.S. dollar index in the downside. And let's check out the sector action. You see a lot more green than red today. It was a different look this morning. Financials is the worst off. That's down 0.5% today. Discretionary and healthcare also in the red. But let's check out the week totals. 5 days, only healthcare in the green. We're going to be talking about this. I'm going to be doing a deep dive with Josh in about 30 minutes. Financials, the worst off. And this is kind of interesting because at the beginning of the week, financials hit a record high. That was that little speck of green, but it was all down from there. And let's get a final tally on the NASDAQ 100 as well, where we can see most of the mega caps, most of the bigger stocks in the red. Google, Alphabet, an outlier there. That was up 2.1%, but check out NVIDIA. That was down about 10%. You can see over these 5 days. And Tesla also down about 10%. So some negative price action in the majors, but I guess a little bit of good news here. China looking up. China's still kicking along, and I don't think traders had that on their bingo card at the start of the year. So a year full of surprises so far, and guess what? It's barely March.
All right, Jared, thank you. Stocks ending a volatile week on an upbeat note, but the major averages still posting weekly declines. In fact, it's the worst week since September. And our next guest says selling is the market's path of least resistance in the near term. Joining us now is Jim Schmigel, SEI Chief Investment Officer. Jim, it is good to see you. You know, it's Friday, Jim. I was hoping we could give some folks some good news heading into the weekend, but I'm looking at my notes here, and you say, what is the trend? That's the selling trend you see seems to be the path of least resistance, at least just in the near term. How come, Jim? Walk us through that.
Sure, Josh. Thanks. Thanks for having me. Happy to be here on a Friday afternoon. Chair Powell had a great effect on the market here into the close, and I'm happy to take a bit of a page out of his book. Despite our short-term viewpoint here, that momentum has really turned, and that is certainly the path of least resistance. There is going to be some profit taking. There is still some leverage in the system from a CTA type kind of global macro perspective that needs to be kind of worked out. And look, the reality is that the market and investors in general are still trying to process the headlines and the theater around tariffs that have been going on kind of all year long. So we aren't negative on the market per se. We still like risk assets this year, broad exposures to risk assets. But I still, despite the effect that Chair Powell had, and I'm happy to close out the week in the green after the week that we've had, we still believe that there's a little bit more selling pressure probably still to go in the U.S. specifically.
Jim, what would halt or slow or even turn around that selling pressure?
Just any little bit of certainty, I think. I mean, so we had a big employment report today. That could have certainly been a catalyst. I wouldn't say it was a dud, but it was it was kind of more or less in line, a little bit of softness in the household survey, which I think people are going to be keeping their eyes on. But any certainty around kind of the tariff situation, the market has really been dealing with the kind of the two sides of the Trump coin, if you will, right? Post-election, everyone focusing on deregulation, lower taxes, all of the positives. And post-inauguration, we're looking at tariffs. Where are they going? How big are they going? Are they going to be reciprocal? Are they going to be blanket? So, focusing on the latter and having the former a little bit more in investors' kind of rear view mirror, that's where we find ourselves today. So a little bit more certainty about what we are going to be talking about with the tariff situation is really what I think this market is just waiting for.
Jim, what did you make of this earnings season? What were your big takeaways, and what do you see for profit growth ahead?
The earnings season, I think, by all accounts, is really, really good. I mean, I think we have upwards of 70%. We've been calling for kind of taking a broader exposure in equity markets. I think that's kind of seeing itself play out in the first quarter here from an earnings perspective. This isn't just a concentrated market anymore driving earnings. The 473 are doing pretty well, and in some cases even slightly better than some of the Magnificent Seven. So good earnings season, decent valuations when you step outside of the Magnificent Seven, when you step outside of the United States. It's still a relatively good market, we think, for risk assets. We have stimulus measures, not only coming, of course, from China, but now a potential game-changing bazooka coming from Europe. So diversification of your risk exposures, again, by sector, by active and passive and value and quality, and even from geography is the game plan that we're talking to our investors about in 2025.
And do you think at the moment, while we're in this momentum unwind in the U.S., that it actually makes sense to add more aggressively in some of those geographies in particular you talked about?
We would say if you are underweight. So, I mean, there are certainly the U.S. exceptionalism trend was really a big one for quite some time. So to the extent that investors do find themselves overweight the U.S. from an equity perspective, we have been recommending just get neutral weighting from a global perspective. We like global equities. It's something that we utilize across our clients and across models. So if you do find yourself leaning into the U.S. Because of how well they've done, maybe you've skipped a few rebalances, we do think it is a good time to get back to a neutral weighting. Make sure you're diversified. And look, the reality is if you're overweight U.S. equities and you're going to go back to a global posture, you're still going to be 70% U.S. equities. It's still a massive part of global market cap. Staying a bit diversified, even from a neutral weight perspective, we think makes sense.
What about gold, Jim? Are you recommending that to clients? And what's the right percentage in the portfolio? Is it 5%, 10%, kind of dialed up or down, depending on the environment?
Yeah, it's a tough from a strategic perspective. We are strategic in terms of our commodity exposure, and that's going to be somewhere between that kind of 5 and 7%. Gold's going to be a portion of that, about 20% or so of that allocation. But right now, tactically, we do kind of like gold, even as a standalone. You're seeing a lot of pressure on yields kind of around the world, particularly outside the United States now with this kind of fiscal boom happening or potentially happening in Europe. You also have the trends that have been in place throughout 2024, which is central banks globally diversifying their reserves out of the U.S. dollars, making gold a bigger part of their allocation. We still see that in place in 2025. It's not going to surprise us if gold goes past that $3,000 per ounce mark this year.
All right, we'll be watching that one. Jim, thank you so much. Have a great weekend.
You too. Thank you.
Stick around. We got much more market domination over time coming up. Less than 2 months into his term, President Donald Trump sending markets on a roller coaster ride amid his policy changes, especially trade policy. For more on this dynamic, we've got Yahoo Finance senior columnist Rick Newman, who wrote about this in the latest Trumponomics. Of course, President Trump saying this week he is not paying as much attention to the stock market this time around, and his Treasury Secretary has talked about paying more attention to the 10-year, but nonetheless, it does seem like there is this, as you called it, a game of chicken.
I think this is the week that Donald Trump developed a fully adversarial relationship with markets. And obviously that it relates to the tariffs that went in place on Canada and Mexico. And then we had this jumping around all week. I'll just summarize this. My favorite economic note of the week comes from Capital Economics. They say, Trump tariff push descends into farce. For those keeping score, Trump has now imposed tariffs on Canada and Mexico that almost immediately done a U-turn twice in a single month. And we're just going to get more of this. So who knows where it's headed. We should discuss whether Trump cares about the stock market anymore or not. Maybe he's just saying that because the stock market is performing badly. I mean, we're not having a crash here, but the U.S. market is underperforming the European market, the Hong Kong market, the Chinese market, even the Mexican stock market. I just got my Yahoo Finance alert saying this is the worst week for the S&P since last September. So does Trump not care about the markets anymore? If he doesn't care about markets anymore, I think that's a paradigm shift for investors because, sort of the rule of thumb with Trump is, yes, he's going to threaten a lot of tariffs, but at the end of the day, markets will be a corrective on anything Trump does that gets too far out of hand. And maybe not. Maybe Trump is going to get out of hand and he's not going to let markets put a check on him this time around.
Do you think there'd be a point, Rick? Because that was something strategists often brought up in this show that, traditionally Trump does look to the stock market as a kind of report card on the administration. So you think maybe there would still be some point where, okay, there's just too much red for too long and he would reverse?
I think here's the way I kind of think about this question is what is Trump's retreat threshold? How much pain does he have to impose upon markets before he backpedals or he actually changes his policy? So I think we got some hints about that this week. He put full on 25% tariffs on mostly everything from Canada and Mexico. He made an exemption only for auto parts. But then he got all kinds of complaints. I'm sure CEOs were calling him up. The market went down a few points and a few points more. So then Trump changed it. Well, he's going to make a bigger exemption for this other batch of products. It looks like it covers about half of all those imports now, but that's only temporary. It's for 1 month. So Trump blinked, but what's he going to do next? I mean, if we have markets falling 4% a month for the duration of Trump's tariff regime, that's going to get ugly. That's an ugly year for markets. So is 4% his threshold? Is 10% a stock market decline his threshold? Or does he not care at all? I mean, remember, unless he actually does think he's going to become king and run for a third term or maybe not even bother running, he is not running for re-election this time, and he's got a freer hand to do whatever the heck he wants.
Well, and he is also surrounded by people who are on the same page as him. I mean, what we're discussing is what the markets have come to call the Trump put, right? What is that level to which stocks will fall that then will force his hand? Ed Yardeni put it another way when we talked to him yesterday. He called it the stock vigilantes, much like the bond vigilantes who try to force a government's hand when it comes to a debt position. Now maybe you have stock vigilantes, but you had President Trump in his comments to Congress this week talking about a little discomfort in the short term, right? But you also had his Treasury Secretary, Scott Bessent, saying, calling this a sort of detox, right, in an interview of government support for the U.S. economy and a shift to more of a privately supported system. So I guess what I'm saying is there does seem to be more of a willingness on the part of the administration to ride this out for these sort of philosophical reasons, if you will.
You could look at it another way, Julia, which is it's just all gobbledygook. I mean, imagine Trump ran on all this last year in 2024. He didn't run on this. Let's keep in mind, he ran on inflation and getting prices down and trying to fix the things about the economy that voters didn't like at the time. He did not run by saying, oh, we're going to have a little disturbance, which is what he said at his speech this week, but we're okay with that. We're okay. By the way, who is okay with a little disturbance? I mean, he didn't check with me. Did he check with you guys? Are you guys okay with a little disturbance? I don't know. You could argue that of all the things that are broken in the United States, the corporate sector is not one of them, and the amazing efficiency of companies reflected in the terrific U.S. stock market is something you shouldn't mess with. So why is Trump doing this? When I hear his aides, Bessent and Lutnick mostly, talking about, oh, they want to reformulate the whole economy, I think they're just apologizing for the damage Trump is causing because there's no coherent theory here. Trump loves tariffs. We've talked about this a million times. We will talk about it a million times before. This is not the correct solution to the problem that he identified, but he believes it is. So I think we're just going to struggle through this, and we're going to hear a lot of apologies in the form of new theories and reformulations from Trump and his aides.
And we'll talk to you about it next week on another Trumponomics. Rick, thank you. Appreciate it. Well, Elon Musk and GOP lawmakers working towards carving out the path to government efficiency. President Trump increasingly bringing his cabinet members into the mix on Doge's cost-cutting measures as members of Congress call for greater transparency. For more on the government's efficiency efforts, we're joined by Matt Calkins. He's CEO of Appian, which is working with agencies under Doge's purview. It's good to see you, Matt. You guys are, I have to admit, I didn't know this about you. You guys are a pretty big government contractor. In fact, that's the source of a lot of your revenue. And so what have your interactions with the government been like since Doge came into play? And are your contracts coming under a lot more scrutiny?
Efficiency is the word of the day in the government. And even before Doge knocks on your door, every one of the agencies is extremely concerned about making the most out of every dollar they spend. So the priority has permeated the government, and it's on everybody's mind. It varies. Different programs are under different degrees of threat, and that's a case-by-case basis. But everyone cares deeply about efficiency right now.
So Matt, but they do care about efficiency. So I'm wondering, given how much you do work with the government, I think you work, correct me if I'm wrong, Matt, but I think you work with 15 cabinet level agencies. I mean, would there be any concern with this focus on efficiency that you all could be kind of a Doge casualty there?
We work with every cabinet level agency in the U.S. government, and frequently we do some really big projects. They tend to be essential projects. We do important things like core procurement, and so they might not be on the front line of the Doge reforms. They might be a little bit more essential.
But Matt, as somebody who has worked on these contracts for government, how do you make it more efficient? Do you cut a bunch of people? Do you, eliminate funding for, USAID or drug research or what have you? In your view, as somebody who's been involved in this kind of stuff, what do you think?
Yeah, let me say, first of all, that the U.S. government could be more efficient than it is. Right? This is a real topic. Efficiency as a priority, it makes sense. There's a lot we could do. We've been, specifically Appian, has been involved in chasing efficiency in the government for a couple of decades now, and there's plenty of it to be found. The government can do more with less, and putting a priority forward that we're all expected to is going to be a healthy thing, I believe. So yeah, I think this is going to be constructive, provided it continues to be implemented in a way that's conducive of being constructive. And I think that we're going to find out, right? The torch is being passed. As you saw yesterday, Trump's statement that all of the heads of the agencies were now supposed to carry on Doge's priorities. I don't know if yesterday was the turning point, but this, one way or another, it's inevitable. The agencies are going to have to take the torch to some degree. And when they do, that's a critical turning point. It means that unlike Doge, which is a few smart people and a chainsaw, we're now delegating this out to the whole federal community. And the federal community includes decision makers across the government, includes the people they trust, the institutions, the companies that they trust. And when the torch is passed, the whole city has to get in on the act.
And just to be clear, Matt, you all are not working directly with Doge.
We are not working directly with Doge, but we do work with all of the agencies.
Go ahead, John.
And what kind of work have you been doing, right? Where are the opportunities, do you think, everybody, I think there is broad agreement that Americans would like to see government get more efficient. I guess I'm just trying to understand, where are those real opportunities for efficiency?
Yeah, well, I could give you an example. A few years ago, it was clear to us that the government spent a lot of time and money doing procurements and sometimes didn't come to the most efficient resolution. Sometimes it took too long. Sometimes there were challenges. Sometimes they spent too much on a purchase. And so we created a suite of procurement software, which has become the standard in the Department of Defense across all the major departments, the major military branches. And that streamlines procurement requirements. It makes it more modern. It makes it more transparent what's happening, and it makes it more accurate. Now, that's a way that we can be more efficient through the use of software. It's taken years to build to that point. We had to prove ourselves time and again, but that was an efficiency operation. We wanted to make the way the government spent money better, and through time and work and collaboration, we did it.
Matt, great to see you as always on the program. Thanks for joining us.
Thank you.
Time now for what to watch next week. Starting off on the earnings front, a lot of big names coming out next week, including Oracle, Adobe, and Dollar General. Oracle announcing results for the third quarter after the closing bell on Monday. Analysts keeping a close eye on the company's cloud sales outlook amid cloud spending concerns from hyperscaler customers.
Moving over to the economy, a key piece of economic data coming out on Wednesday with CPI, that's the Consumer Price Index. Economists forecast both total CPI and core CPI, ex food and energy, for February will slow to 0.3% on a month-over-month basis.
And more fresh inflation data is coming out on Thursday with PPI, that's the Producer Price Index for February. Total PPI expected to slow to 0.2%, while core PPI holds steady at 0.3%. All the new data painting a clear picture on inflation as the Federal Reserve prepares for its next interest rate decision later this month.
And tune in next week for Yahoo Finance's special coverage of CERAWeek 2025. That's where industry leaders are coming together to talk about the future of energy. We'll have interviews on Monday with Mike Summers, he's the American Petroleum Institute CEO, John Ketchum, NextEra Chairman and CEO, and Joseph Dominguez, Constellation Energy CEO. You don't want to miss that. That'll do it for today's Market Domination Overtime. Be sure to come back on Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Oh, and it's Daylight Savings this weekend.
That's right.
That's something else.
Good reminder, Julie Hyman. But don't go anywhere. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned.